Welcome to the Daily Drawdown, where today's rally meets AI's Capitol bill. Stocks are ripping to records, but the bigger story is underneath it. Broad participation, earnings support, and a huge acceleration in AI spending financed with real leverage. That combination can keep working, but it also raises the cost of being wrong. The S&P and Dow closed at all-time highs. The Nasdaq was up roughly 2.5%. And this was the best four-day rally in more than a year, with 4 straight gains of over 1%. What matters is breadth. Roughly 2/3 to 70% of major stock universes are back above their 200-day moving averages. So this doesn't look like a rally carried by a tiny handful of mega caps. The main fuel has been earnings. Blended quarterly growth is running near 29%. Some measures are much higher, and the beat rate is around 85% against a 5-year norm closer to 70. That is why year-end S&P targets around 8,000 to 8,250 are still being defended. The argument is record forward earnings above $400 a share, with only modest multiple expansion needed if profits hold. Technicians are framing the recent shakeout as a reset, not a macro break. The story is rotation out of crowded longs, deleveraging in levered products, and redistribution of risk rather than a collapse in fundamentals. Flows back that up. SPY and QQQ call buying ran about 30% above normal, the VIX dropped below 15.5, and the call to put mix points to fear of missing out more than fear of recession. That can support upside in the short run, but it also means positioning is getting hot again. If the next catalyst disappoints, fast money exposure can unwind just as quickly as it rebuilt. The next leg of the market still runs through AI, and the spending numbers are getting extreme. Amazon, Google, and Microsoft are expected to throw off roughly $210 to $250 billion of operating cash flow next year, which is what gives the capex cycle room to keep running. At the company level, the numbers are huge. SpaceX reported $15.8 billion of second-quarter AI capex, and AMD disclosed $808 million of capex, both reinforcing that infrastructure spend is broadening beyond the usual hyperscaler list. The practical question now is return on that capital. If cloud and model demand keeps compounding, the spend looks justified. If utilization lags, investors will stop rewarding growth and start interrogating payback periods. Compute ambitions are now measured in gigawatts. Public targets range from 2 gigawatts by year-end to eventual plans around 15 gigawatts, and at an estimated $40 to $50 billion per gigawatt. That implies something like $600 billion of capital for a full build-out. That scale pushes financing to the center of the story. Analysts estimate about $1.65 trillion of private debt is tied to the AI trade, and a reported $30 billion Blackstone facility backing Anthropic TPU purchases shows how much of this ecosystem depends on structured funding, not just clean balance sheet cash. That matters because higher rates, softer demand, or tighter liquidity would hit AI through the financing channel first. This is one of the clearest systemic watch points in the market right now. Valuation risk sits on top of that. Examples being cited include SpaceX trading around 55 times revenue versus roughly 10 times for Alphabet and 20 times for NVIDIA, while some private AI names are being valued at levels that assume years of flawless execution. SpaceX beat on revenue and EBITDA, with Starlink contributing nearly $4.9 billion, but the stock fell after the report. Investors are wrestling with valuation, guidance quality, oversized capex, and whether ambitious claims on satellites, Starship timing, and future revenue are credible enough to support the price. There is also a market structure issue here. Lockup expiries, a potentially large future float, and heavy options activity mean the stock can move violently around each headline. AMD had a similar setup in a different form. Revenue, earnings, and data center sales beat, and next quarter revenue expectations moved higher, but the shares still fell on margin and guidance nuance. The key watch items are supply and ramp timing. Investors want proof that MI450 and Helios can scale cleanly and that Venice CPU gains continue, because the market is no longer rewarding AI exposure by default. Within semis, memory remains one of the strongest demand pockets. SK Hynix, Micron, and other advanced memory suppliers are benefiting from AI workloads that are outpacing capacity, with some advanced memory supply effectively spoken for deep into 2027. There is a geopolitical angle, too. Cheaper Chinese AI models are compressing compute economics, while a proposed U.S. draft ban on Chinese optical transceivers could redirect demand toward domestic suppliers like Coherent and Lumentum. At the software and application layer, Palantir stood out. The company posted another blowout quarter, raised guidance, and leaned hard into data sovereignty and enterprise control, arguing customers should not hand sensitive intellectual property to outside model labs. That positioning matters because if foundation models commoditize, more of the durable value may sit with companies that own the workflow, the data, and the deployment environment. The bond market is still a source of uncertainty. Fed communication has become less predictable. Debate continues over whether the next move is a pause or even a September hike, and 10-year yields have pushed higher, with inflation expectations also firming after dovish-sounding messaging. Higher yields matter here because they raise the discount rate on long-duration AI assets and increase refinancing stress for the private credit structures supporting the build-out. On energy, a possible U.S.-Iran arrangement tied to reopening the Strait of Hormuz helped pressure oil lower in some discussions, while yen intervention by the U.S. and Japan added another cross-asset variable through treasury flows and carry trade pressure. Meanwhile, the physical build-out keeps running into real-world constraints. Texas is requiring more audits and disclosure for new grid-connected data centers. New York has imposed a temporary moratorium on large-scale projects, and that kind of fragmentation could reshape where AI infrastructure actually gets built. That helps explain why industrial and energy names are seeing second-order demand. Caterpillar added about $9 billion to backlog with management pointing to data center power demand, and Williams is expanding gathering capacity with fresh projects and financing support from Blackstone. On the legal front, Apple sued OpenAI seeking device data and documents tied to former Apple engineers now at OpenAI, with an injunction hearing noted for October 1, while OpenAI also settled a DOJ civil rights matter involving alleged bias toward visa holder workers. In banking, Wells Fargo said it plans a tokenized deposit platform this fall for near real-time cross-border settlement and continues to push cost cuts, buybacks, and balance sheet growth after the asset cap lift. In consumer names, Booking beat and rallied on resilient travel demand. Pinterest beat but fell on merely inline guidance, and Nike is still dealing with regional execution problems. The common lesson is simple. In this tape, forward guidance matters more than the backward-looking quarter. The market has earnings, breadth, and momentum behind it, but it also has crowded positioning, giant capital needs, and more financing risk than the headline indices suggest. That's the setup to keep in mind. This is the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.